All right, everybody. We are getting things cranked up. And we will begin here shortly. Matthew, you may have to, I may have to go run grab Matthew real quick. We're having a little bit of technical difficulty with Matthew's equipment, but he's down the hall from me, so that's not going to be a problem. All right. Josh, I'll be right back, okay?
See you in a second.
All right, be right back.
Well, as I sit here as the lone duckling, got a comment that I might should do my dance routine. I don't know if I want to subject anybody to that type of visual violence at this hour, depending on where you are in the country. But I think Matthew and Spencer are working through their issues. Looks like Matthew's connecting in now, possibly. Or not. So there may be a poll to this effect. So I don't want to be redundant, but if you are on and you want to drop in the chat where you're pinging in from, you can just use city or state. It'd be great. We'd love to know where you're coming from. There may be a poll to that effect we do here in a moment also, but just curious where everybody is coming in from. Oh man, we are already up and down the East and West Coast. That's fantastic. Wow, how cool. Bunch of California, Pennsylvania, Chicago, Indianapolis, Nevada. Fantastic. So glad to have you all here. We'll be getting started here in just a couple of moments.
Here we are. Here we are, everybody. It's great to see where everybody's coming from. We're having a little bit of difficulty with Matthew's setup, so he's joining me in my office for this webinar. So this could be,
per usual, pretty rookie mistake. We
That's
probably
right.
should have tested this before we got going, but I guess I'm going to get to stand next to Spencer this whole 2 hours. So not something I was looking forward to, but
this is not
but
good.
I'm here. Good gracious, Hawaii, Tampa, California, great.
Dallas. All right. Well, good deal, everybody. Well, thank you for joining us. We're going to get started right away. So what we have for you today, we're excited about it because we have slated for 2 hours, and we're going to talk all about M&A. And we have two guests who are going to be joining us. We have Steve Brown and Misty Berger who are going to be joining us on stage probably within the next hour. And we're going to open up Q&A. You can ask them whatever you want to know. Now, we have made the chat private in case somebody wants to ask a question they don't want other people to see or whatever. So feel free to ask whatever you want to. We're gonna kick it off with them probably in about an hour. So we definitely want you to stay around for that. And we've given a good bit of time for them to come on board and answer all your questions. Of course, you can ask us questions. Matthew is an expert. Josh Heintz is an expert, which I'll introduce Josh here in a little bit. But Matthew, before we get going, you want to tell a little bit about like why we're doing this and kind of the genesis of all this?
Yeah, sure. If anybody listens to our podcast, you know we aren't experts yet, but No, listen, we wanted to expand on what we were doing with our podcast. So we appreciate everybody that's been listening to that over the last couple of years. We started that and didn't know where we were going to take it, but I think Spencer's done an incredible job of growing that audience, and appreciate all of you for downloading that podcast. For those of you who don't know, it's called 300 to 3000, How to Grow Your Property Management to Scale. And you can find that on all the different podcast platforms. The other thing I would add before I get started about why we're doing this is also special thanks to Appfolio. They are the ones that are sponsoring this. I think we got like a bean burrito out of this from Appfolio. I'm kidding if you're on here from Appfolio. No, they're great partners of ours. We use their software, and so really appreciate them being willing to sponsor what we're doing here. So the whole idea of this is, we want to help businesses. So one of the passions for Spencer and I, and really for Evernest, is to help people grow personally and professionally. And one way to do that is our podcast, but we wanted to grow that. And so that's why we decided to kick off this webinar series. So we'll be doing these webinars the first Tuesday of every month at the same time from 3 to 5 Central. And so we're pretty excited about this, because we're going to hit and dig into some topics and get some audience participation, get some feedback. And to be honest, we kind of kicked it off with mergers and acquisitions because we knew a lot of people would sign up. So the next one's going to be on sales. So we're just a glutton for getting off on the right foot, because we know sales will also drive. So go ahead and think about being here in March for our sales webinar. But yes, look, it's no secret that our industry is going through a little bit of a change, or maybe call it a big change. And mergers and acquisitions of property management companies is a big piece of that. And so just to kind of level set where we come from, so Evernest, we started Evernest about 12 years ago, and it was during the recession when we essentially couldn't buy and sell houses anymore. Spencer and I were in the buying and selling house business, and I started Evernest with some other folks, and we had 30 houses that we couldn't sell. Since then, we kind of puddled along through the recession. And in 2013, decided to turn from buying and selling houses to focusing on growing the property management business. And so that's what I've been focused on. And then Spencer got out, did some other things, and then came back. I talked him into coming back. Actually, he's the reason I'm in this business. So I drug him back to help grow this thing. And we have this kind of crazy goal to grow to 25,000 homes under management. And one way we do that is through buying and selling property management companies. And so, but there's enough to go around, and this is not like a secret playbook. We're happy to share best practices with you, and we think that anytime we can create some positive energy in the industry, then that's a win for us. And then there is an element of, we also hope that at some point, if you decide to sell, then you would sell to us. But we're not doing it just so you can sell to us. We're also going to be very transparent throughout this whole process of talking how we do that. So we've to date bought 37 property management companies, and that dates back to 2014 or 2015 when I bought a property management company here in Birmingham from a friend of Spencer and mine. And so we've obviously figured out some ways to do it really poorly, and we figured out a few ways to do it successfully. And so we're going to talk about that. But the first topic I think we want to cover is kind of the state of the property management industry. And so Josh Heintz, who runs our property management mergers and acquisitions, he's on the business development side. I know a lot of you all probably see him at some industry events. Josh, why don't you kind of kick off how you see the state of the property management industry from a mergers and acquisitions standpoint, and then maybe Spencer and I'll jump in with some color.
Yeah, and real quick before we get started, I did want to say, we didn't create some big slide deck or have this big presentation. We thought that this was going to be a lot better, just kind of a round table. And so that's what you can expect, is just kind of very casual conversation. And then again, we're going to have the Q&A with Misty and Steve down the road. So go ahead, Josh.
Well, let me just start by saying it's such an honor to be able to be on the same panel as a couple of property
Sarcasm,
management.
sarcasm. We get it. We get it.
No sarcasm at all. I mean, so I've been with Evernest for a little over a year, and it's been amazing going, running around the country, going to a lot of different conferences. The amazing name that Evernest has in the industry, and like Matthew said, we're not the only show in town. We never want to claim to be. There are a lot of people that are doing great things in this space, and I'm just honored to be a part of one of them. But you know, when I'm going around and I'm at these conferences and I'm talking to people, acquisitions are naturally a big part of the conversations that I'm having, but they're also big parts of the conversations that are just happening at these conferences. And so when you are somebody who is interested in buying or somebody who's interested in selling, there's a story that everybody wants to hear. And it's, you know, why is this happening? Why has this become such a topic over the last couple of years? People have been buying and selling property management companies for a number of years, but it's really been the last couple of years that things have really just kind of hit that hockey stick curve and just, you know, skyrocketed up. And a lot of that is because there is institutional money being poured into companies that manage properties to grow and to scale. And so one of the things I wanted to touch on real quick was just the archetype of the typical buyer that's out there. And so really you have effectively three different types of buyers. You have what would be a more traditional roll-up. So if you think about a company like SC Johnson, right, that has a ton of subsidiaries. They own, you know, Colgate and Palmolive and, you know, Pampers diapers. I don't know if they own any of those, but you understand what I'm saying. There are companies that are out there that are effectively a parent company that are going and buying property management companies to roll them in or under their umbrella. They leave those companies effectively in place to manage as is. What they're doing is they're acquiring operators. And so if you're running a property management company and you were to sell to one of these companies, a lot of times that comes with, you know, they want you to come in, and then instead of effectively the net profit going to you, then the net profit then begins to go to that parent company that has bought you, but everything else generally remains the same. Another type of buyer, which is probably the overwhelming majority of buyers in this space, are asset purchases. They're coming in and their plan is they want to take your company and they want to fold it into theirs, but they don't want to leave you to run and just roll your net profit into their company. They want to incorporate or integrate all of your processes and potentially your people and your portfolio into that company. And so that's kind of more traditional asset purchase. And then the last, which is not new by any means, but is new-ish to the industry, and you've seen a lot in the prop tech space, is companies that are primarily a property management tech platform that are needing a portfolio to be able to pull into their tech platform to allow them to grow and scale through that technology. And so you're seeing a lot of venture capital backed companies that are coming into this space. They're buying up companies so that they can roll that portfolio, those management agreements into their tech platform to allow for scalability. And so those are, generally speaking, the three different archetypes to the types of buyers that are out there right now. And the reason that this has been such a huge talking point is because there's been a lot of institutional money come from behind venture capital, some people behind private equity, to help fuel this surge of interested buyers who are looking to grow and expand. And these people are, you know, some are national. There are a handful of national people that are buying all over the country. There are a few regional people who really kind of want to stay in their pocket in the country. And then, as everybody's probably aware, their local companies have always and will always continue to consolidate and invest and divest within their local regions as well.
Yeah, let's talk a little bit about why these bigger organizations want to see this as such a big opportunity. You know, one of the things that they see is the cottage nature of the industry. This industry is, a lot of very small, what they would call fractured. It's a fractured industry, meaning there's just a lot of really small players in the industry. And so anytime they see something like that, then they see an opportunity to what they call roll that up under one umbrella and then, make it a national brand. There's a lot of companies out there that have done that. I think it's CVS or Walgreens for a long time was buying, independent drugstores and pharmacies. So that's the type of thing that this is not like new. This is new to our industry, but it's not new nationally, right? Like this is happening in other places. And so, there are a lot of other places similar to ours that are being rolled up right now that we know people are like in the vet clinic business. So they're buying independent vet clinics and rolling them up under the same brand. I know dentists are doing the same thing right now. And so any industry that just hasn't had that happen, you're going to get a lot of attention. And that's what happens here. And so the cool thing about our business is that, and the thing that they like is the recurring fees. So the management fee flows in every month, and the reoccurring fees, which are the ones that are happening on a fairly regular basis, because as our business grows, it has pretty predictable income, and they like that. So if you have predictable income, then they can kind of like model out how much money they can make, over some period of time, and then they can figure out what that's worth to them. So that's kind of how the industry is starting to think about that. Anything you'd add?
That's it. All right. Well, that's the state of our industry and the M&A activity going on. So why don't we shift gears a little bit? We have a poll up here, and it's like 52% of the people who responded to this poll are interested in buying property management companies. So Josh, I'm just kind of curious. You talk to a lot of different property managers. Matthew, you do too. You do as well. Like, it seems like even in just like these general conversations with friends or whatever, like this topic is coming up. Like they're looking to buy or grow through, maybe even like we talked about, like even in their own market. So talk just a little bit about this subject here, buying property management companies. You're muted.
You're probably muted.
You're muted.
Yep. Well, I'll start with the buying. Clearly rookie mistakes on all of us. But look, So buying right now. What was the question? We were talking about buying.
Yeah. We're kind of the intro to buying property management companies.
Yeah. Look,
like, why is this such a hot topic?
Yeah. Look, I think one of the things that people see is just the opportunity to grow the business fast. And what I found was it was really hard to grow the business from 0 to 300 homes. But once you got like some density in a market, it was way easier for me to grow the business organically. So I think a lot of people see that as well. And so, or they have a friend that's been in the business. We are members of an organization called NARPM. A lot of times you'll have a friend that you've been attending some of these seminars with, and they come to you and say, hey, I'm looking at getting out of the business. Would you buy my business? Mm-hmm. And so, having those contracts and part of this is also understanding like how to do that, right? We have the benefit of having gone through this a number of times. Each seller, which is why we're bringing on the sellers, is very unique. It's like the one time they go through the sales process. So it's all about like understanding the buyer process. But Josh, are you back on now?
Yeah. Can you hear me now?
Yep.
Yeah. Okay, great. So, a lot of it is two sides of the same coin, right? And so you hear a lot of this that applies to buyers also applies to sellers because, it's just two different sides of the same conversation. But buyers typically have certain types of questions that they want answered. Like they want to know, how do I find somebody to buy? How do I know if that opportunity is a good deal or a bad deal? How do you go about raising the capital to buy? How do you go about determining what you do with, personnel in the company that you're looking at? How big is too big? Is expanding right now the right move for us? And one of the things that's been really neat in having these conversations with potential buyers is a lot of the times people are asking the question, am I ready? Like I've gotten, Matthew and Spencer in that 303,000. What we know is as you grow your property management companies and what you have seen in your individual companies is there are these certain thresholds where you have got to grow and you've got to expand and you've got to stretch yourself before you really see returns. There's a little bit of a gap there before you can go to that next plateau. And people find themselves kind of caught in the middle. And a lot of times people are asking themselves, okay, I'm at 300 units, I'm at 500 units. Now is the time I need to either hone in and make this the most profitable 300 units that I will ever run in my entire life and stay here. Or if I'm going to grow, how do I get past that next hurdle into the next stage of profitability? And a lot of times adding 50 to 75 units is not really going to make you more profitable. It can actually make you less profitable. And so a lot of people see the opportunity to buy is getting to that next plateau where they have the opportunity to go to the next stage, become more efficient, continue to maintain a profitable model without having to go through the pains of growing door by door through 100, 200, or 300 additional units. So it's immediate scalability. And some people are intuitive enough, and I think this crowd would be as well, to step back and ask myself, am I wanting to grow for the sake of growing, or am I wanting to grow to get better? And so a lot of the people that are asking that question are typically ahead of the game in trying to figure out, is now the right time to step out and buy? And so Matthew, what was it that the first company that you bought, why did you decide in that moment that that was the right time?
Yeah, this has been my message within the industry is like, know why you want to grow. One of the reasons we're doing the 300 to 3,000 podcast, we're talking about how to grow the property management company from 300 to 3,000 units. And what I saw was that there was a huge change in what was required of me and from Spencer as we grew from that 300 to 3,000, right? Like at 300, it's a great business, super profitable, maybe one of the most profitable per house, just because, all the ideas and all the work goes through kind of like one central location. We call it the genius with 1,000 helpers, and they're able to execute really well. But that's a great business, but it becomes different as you grow to 3,000. So as you get to the 3,000 mark, you're going to start to know how to lead and manage people, learn to communicate. It just takes on a different. I don't manage a lot of homes today. My job is to make sure Spencer shows up at work on time every morning, and to lead and manage the organization and share a vision and kind of like tell everybody where we're headed. But it's long since outgrown property management or me managing properties. And so what I would say to you is, don't just grow for the sake of growing, but grow with intentionality. If you want to be a business owner and grow a business where you're leading and managing people, that's great. You need to know that there's going to be some, it's going to be hard to get there. There's going to be, it may, like Josh said, it may cost you money to get there. But also remember that there's nothing wrong with running a 200 or 300 unit business very profitably and making a lot of money doing that. There's certainly going to be the opportunity to do that in the future. So, look, from a buy standpoint, to answer Josh's question, I never really made that decision. The only thing I knew is that growth was better and growth was good when I first got started. And so I thought if 100 houses made this much money, 150 houses would make 50% more. And that, again, like Josh said, that's not always the case. But it did help. Again, it did help me learn how to do it and got me started with this idea of growing a national property management company. And again, let's jump in, Josh, and talk a little bit about, what do we look for when we're buying a business? So we're buyers. We're out there proactively buying. Let's start with, what do we look for when we're buying?
Yeah, and it kind of rolls back into the conversations about how do you find deals, how do you evaluate deals, how do you know what's good? And a lot of times when people are asking that, they want a really binary answer, right? It's either this is a good deal or this is a bad deal. But the truth is, what is a good deal is going to be relevant to what your strategic goals are for your company. And so for Evernest as a company that is currently managing 15,000 doors and right around 30 different markets in the country, our goals are going to be different than another property management company, either another national property management company or a local property management company. And so determining what is important to you is critical. But for us, a number of the things that we look at, one, we are interested in, the market itself. We know that if we were to look in a very, very small MSA in rural Iowa that might have an MSA of 50,000 people, that's not going to register for us for what our goals are. We have a certain sized market that we typically want to operate in, and so we're going to look for opportunities in those markets. We also have institutional partners, and so some of those institutional partners can help us develop an interest in moving into a market. If we have institutional buyers that are saying, "Hey, we're buying here, would you consider, opening up a shop here?" Well, then that can drive our interest in standing up an operation there, so that we have the ability to serve our institutional clients as well as drive through our what we call Mike and Mary, our residential clients. And so when we're going that direction and we're looking at the different opportunities, MSA size is usually going to drive a lot of those decisions in terms of markets of importance. But it's also, where are we? So we're headquartered in Birmingham. We're in 30 different markets. We currently go as far west as Tucson. But we have a pretty large presence in the Southeast. And so it makes a lot of sense for us to grow in the Southeast. And so markets in the Southeast are of particular interest to us, but we also have other national inspirations. And so we're always willing to talk to pretty much anybody, but we know MSA size has a significant standing there. Along with that, and along the same lines, is just strategic importance. For us, just because it's a large market, you could look at somewhere like a Dallas and say, Dallas is a very large market. Clearly it is. You can look at a Las Vegas. You can look at a New York City. But just because it's a large market, just because New York City is home to however many millions of people it is, that doesn't mean that it's strategically important for us. It may be strategically important for somebody who is already operating in the Northeast that wants to expand into that market, but for us, it may not. So whatever is important to you is something that you really need to pay attention to, and that's obviously going to be driven by you and your executive team and your strategic goals and where you want to be, where you see yourself on your roadmap. And then we look at pretty simple things like, what is the average rent? Typically, most people, there's flat fees definitely are out there, but the overwhelming majority of people charge a percentage of rent as their management fee. And so the market rent, depending on what the market rent is, can have an effect on what the value of the company is, because the higher the rent, the higher the management fees, the higher the management fees, the higher the revenue, and so on and so forth. But also you can take advantage of rent appreciation. And so we do look at things like market rent, and there are many others. What are some things, Matthew, for you that really pop out when you're thinking about an opportunity? And we can think back to some of the deals that we've done in this past year as things that kind of stood out to you as, hey, that's somewhere I really want to be.
Yeah, this actually gets into Travis's question. Travis says, when you acquire a PM company, do you ever consider, or do you currently keep the owner operator on staff if that is their desire? So I think this gets into just strategy, right? Like, we typically don't. We have kept people. We have team members right now that were from businesses that we acquired. We don't generally keep the owner operator. One of the things that we like to find are operators that are either getting out of the business or somebody that is retiring. And so that's a strategy, right? Like, there's a lot of national brands that are out there wanting to acquire owner operators. And so that's a certain strategy. And we choose to go for the retiring or somebody that's getting out of the industry, because we like to integrate the business into the Evernest way. But a lot of it is all around your strategy. So that hopefully will help you, Travis, with that question of how we handle that. But the answer is it just depends on who's doing the acquiring.
We're actually going to interview Steve and Misty, and they both sold and they're still on our team.
Yeah, it's not like we don't do that, but of the 37, I think 33 or 34 of those actually 33 or 34 of those actually rolled off. So the other thing I would say is it's very important to see what the largest owner is or what the largest 3 or 4 owners are. One of the things that we're focused on is making sure that that there's not a lot of client concentration. And so when you have client concentration, so let's say one owner makes up 20% of that portfolio. If that one owner leaves, you've lost 20% of the business. And so having that one owner make a decision to leave obviously costs money. And so when you pay like X dollars, immediately that goes down. And so a lot of times what we'll do if there is a larger owner is tie some sort of what we would call clawback or some sort of incentive that keeps the owner with us for a certain amount of time. The other thing is just like average units. So when we look at the whole portfolio, we have like profiles of the type of people that we manage for. And so we want to see a lot of like smaller owners, the 1 to 2 house owners. We call that Susie and Steve homeowner versus Mike and Mary the investor. Not that we don't like Mike and Mary the investor, but again, it's just a different profile. There's a lot more risk when you acquire a bunch of Mike and Marys that have 5 to 10 to 15 houses. And so we look at the average units per owner. We call it UPO. And then, of course, we're just trying to see how well the business executes, right? Like it's always, you think, a lot of people think, well, if I go buy a bad business, I can like integrate it and make it way better and everybody's going to love me. Well, that's not always the case. What we have found is buying better businesses, to use a Warren Buffett and Charlie Munger-ism. We want to buy better businesses at a fair price versus bad businesses at cheap prices. So when we look at a business, we're going to focus on things like occupancy. Are they able to keep their occupancy up? Do they do a great job of leasing houses? Years in business, you can imagine the longer somebody's in business, the more stable the business is. If somebody's grown this incredible business over the last 2 to 3 years, what we would think is that's a little more risky because it's like too much growth too fast, which is kind of funny coming from us to say that. And then, of course, Google ratings, right? We all know how hard it is to have a decent Google rating in property management, but any property manager that's been super intentional about their Google rating, we think is industrious enough to think out ahead of these things. And so we do look at the Google rating. And one of the things we found, this is a tip, if you're moving into a new market and that's your first acquisition and you decide to office out of that location, you're going to inherit that Google rating. So just know we've inherited like 2 stars, 2.5 stars before. And so we
didn't even follow our own advice. We looked at they had such low Google ratings. We still bought them.
This is do as we say, not as we do
correct,
type.
Yeah. We learned our lesson.
So this information that we gave you, I actually have it pulled up from our what we call investment committee spreadsheet. Josh went through some of it. I went through some of it. This information is how we score a business. The whole idea is that Josh, before he comes to our investment committee, which is made up of about 6 or 7 of us, we actually had an investment committee meeting today. And we talked about, he scores the business on these, 8 or 9 items. And we'll provide that list to everybody so that they can, if they didn't write it down. But the whole idea is that we're trying to score the business. How good of a business is this? And Josh, we actually had a business today. Let's talk a little bit about it without giving names. We actually had a pretty decent sized business we reviewed today, but some of these things they scored pretty low on. If I recall, it was units per owner, largest owner percentage, and average rent. And we were just kind of, there was a lot of quietness in the room as we were talking about it. And talk a little bit about kind of like our fears as we thought through those 3 things.
Yeah, no, great case study to kind of talk through something that's very fresh and that we just walked through today. Great opportunity in the Midwest. Very, very well-run business, very established, had a lot going for it. And as we looked at it, a lot of things looked really good. But the deeper that we dove into it, we looked at so this organization had their largest owner owned about 8% of their portfolio. That in and of itself isn't going to, cause us to lose sleep at night, but it is part of a story. And so when you see that, typically the next question is, okay, well, if that was the largest owner, well, what about the next largest owner? Right? Because then if you get into, where your top three owners make up a large percentage, it can cause some concern. And that's effectively what wound up happening. The top three owners made up about 20% of the portfolio. And so for us, that's where we start to get a little bit of heartburn, because we start thinking, okay, we could come in, there could be, issues, because at the end of the day, we're dealing with people, right? I mean, whenever you acquire business, for anybody who's looking to buy a business, when you buy a business, you need to understand, especially in an industry like property management, you are buying the relationships with people. That's what you're purchasing, right? I mean, yes, the management agreement is the tangible asset, but generally speaking, you are going to be working off of the good faith and name of the person that you're the seller that you're acquiring. And you've got to hope that that things with their owners have gone so well that they will trust that owner, that owner has made the best decision in who they chose to sell their business to. Because if you come into an environment where an owner had no idea, and they were a consequential owner, they may be the largest owner in the portfolio, all of a sudden it's, hey, I've been doing business with John for, the last, 10 years. Well, I don't know Matthew. I don't know Josh. John is who I was doing business with. And so you've got to have a good understanding, a good feel for what you're walking into. And what we consider a really valuable business is one that is highly diversified. So Matthew touched on that units per owner's number. And the way that we look at that, just to give you a little bit more color, the way that we usually score that is we take the total number of units that are managed. So let's just say hypothetically the number is 500. And we take the total number of unique owners being, as everybody's aware, you can have one, John Smith, but John Smith may have, 12 different LLCs as owners. We still consider those 12 one owners. So you want to find the total number of unique owners. And let's say the total number of unique owners is 500. That would be wildly unlikely. We've never seen it happen. But then you would have 500 properties, 500 units, and 500 owners. That would give you a units per owner of 1. Conversely, if you had 500 units and 100 owners, that would give you a units per owner of 5. And so the way that we score it is we want to see that number somewhere between 1 and 2. For us, if that units per owner is somewhere between 1 and 2, we feel like that's a well-diversified portfolio, and we are not going to be taking an outsized risk, because the odds that Spencer doesn't like me may be high. The odds that Matthew doesn't like me may be high, but the odds that both Spencer and Matthew don't like me, hopefully they won't say anything differently here, but it's probably low, right? And so the more people that you add to that, the more that you diversify your risk. And that's what a lot of this is about, is as a buyer, you're wanting to reallocate as much risk as possible. As a seller, you're also wanting to reallocate as much risk as possible. I mean, so this is a two-way street. Again, this is a people business. But to complete the thought as we were going through it, units per owner of 1 to 2, we consider good. And the closer to 1, the better. So 1.1, excellent. Anything from 2 to 3 is it's average to okay. Anything over 3, we consider a little bit of a concern. And that in and of itself, we never take any one of these things and use it as a universal truth to whether it's a good or a bad idea. But what we do is we take this list, and this list, as we go through it, begins to tell us a story. if we have a lot of things confirming good, or a lot of things in the middle, or a lot of things that are bad, or even the balance of those things, it begins to tell the story of what are the qualitative and sometimes quantitative variables outside of the financials, because the financials are important too, right? We haven't talked about that. Things like EBITDA and things like your revenue per door.
Questions we're going to answer about that.
Absolutely. So, but those are things that are critically important, right? You got to be able to generate income. You got to make money. I mean, that's part of the business. But there are these other qualitative and quantitative metrics that are outside of the financials that we take a deep look at to evaluate how good is that opportunity. And today, as we went through and looked through an opportunity, we came back with some concerns. Now, we didn't just say no, but we had a nice roundtable discussion about this is what's concerning. What would a comfortable number then have to be for us to move forward with this particular opportunity?
Yep.
And so that's where we wound up landing on that.
So you basically, it's called, what we think of it as like a risk adjusted offer, like high risk. Then we would adjust the offer down to account for the high risk of it, and that's kind of how we were thinking about it. A couple of things. Let me just read off real quick. A deal that we did. We've actually closed on it. This is a deal we did over in Atlanta. So reason for leaving, this person was retiring. So we scored that very high. That was a green. MSA size. Clearly Atlanta has a big MSA at 6.1 million people. That was a green for us. Strategic importance. We called it medium. So we scored that a 2. The type, a tuck-in. So we think of a new platform as being something that we would go to a new market, and we prioritize what we call tuck-ins, which means in-market acquisitions over new platforms, because tuck-ins are more accretive, meaning, if you already have infrastructure there, if I already have an office there, if I already have what we call a team leader or director of operations there, then those businesses, we make more money off of them. So we prioritize that. So we already had an Atlanta office there. So this was a tuck-in acquisition. The average rent was over $1,700, almost $1,800. That's high. Units per owner, 1.2, as Josh said, that's a positive. Largest owner is 4.7%. So not a lot of client concentration there. Occupancy was 89%. So we scored that a 2, which is kind of a not a red, but right in the middle. And then years in business, over 20 years, and then Google rating 4.2. So that was a business that we bought and we were very excited about. So if you want to, we're not jumping into the sales side yet, but if you want to know what to look for on the sales side, those are the things that we're looking for. All right, let's
answer some of these questions.
Let's save the EBITDA question for last, or the multiples question for last. If a PMC company charges a bunch of fees that you don't, I assume you discount that revenue. Yeah, look, we have done that, right? Like if they charge a fee that we just don't feel like we can execute on, or we don't feel like we can, we don't feel good about charging, then yes, we would take that out of the kind of like how we think about that business. But I would also urge you to, this is a great opportunity to look at how other people are generating income, and it's allowed us to make better decisions with our business. So I wouldn't just throw out, the proverbial baby with the bathwater there. I would also take a hard look at it and see if it's actually something you should institute in your business.
I would add to that. It's atypical for us to remove what we would consider like an invalid revenue source. But the way that we would typically look at something like that, let's say that you started charging a Valentine's Day fee that you started 2 months ago, that you're putting on as $5 on your owner statement. Well, there's not enough history there. There's probably going to be backlash, and so we will look back typically as a buyer, and I would encourage you to do the same thing. You don't want to just look at last month's income statement if you're talking to somebody. So if they charged a certain amount last month, that may have looked radically different than, December or November or October. And I can't keep going backwards because I can't think of the months off the top of my head. But you would want to look at what we do is we look at the trailing 12 months, which means we want to start from most people now that we're February the 2nd. People have not probably closed their books for January yet. But let's say that it was a week from today. Most people would have January closed out. So we would want to see December or February of the prior year to January of this year. We want to see the previous 12 months, wherever we're at and wherever we're looking at that. And then we'll also want to look at the 2 years prior to that. So right now, if we were to talk to somebody, we would say, hey, we would like to see your last 12 months, which would be February of 21 to January of 22. And so we'd look at that 12 months, and then we'd go back and say, okay, we have an idea of what roughly 2022 looked like. So can we also see your 2021 and your 2020 financials? And so if we look back to 2020, 2021, and then effectively over 2022, and we saw where there was just 1 month where you had been charging a certain revenue, there's not necessarily proof of adoption in that revenue stream. So we will ask more questions about that. We may make adjustments for that. But unless it's something we truly don't believe that we would be able to continue to implement or execute on, we would possibly give you credit or at least partial credit for that if it hadn't been all the way proven out.
All right, let's jump straight in for the sake of time. We're gonna wrap up with the whole, what do we pay for property management companies, or what are property management companies going for? Those of you who also ask questions, we're leaving some time at the end of this whole thing. We're going to hit the sales side next, and then we're going to leave about somewhere around 30 to 40 minutes for questions at the end of it. So we're going to get to them. We just, for the sake of time, want to keep this thing moving. But the big question in the industry is like, what do you pay for property management companies, or what are people paying for property management companies? Before I answer that, I want to talk about like different ways of looking at it, because everybody looks at it a little bit differently. There is like a revenue multiple, which is pretty easy, right? Like, what's the top line number that they're bringing in? There is like an NOI, net operating income, or EBITDA multiple that is, basically what money comes down to the bottom before EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. And those are kind of like the two ways to do it. There's also the third way would be like a number per unit. In other words, hey, what are you paying per contract that you're buying? The way we look at it, mostly the way we think about, let me tell you just the way we think about this. We think that the smaller companies, and when I say smaller, forgive me, I'm not trying to be offensive, but when they're below $1 million, EBITDA is very hard for us to determine, right? Because there's things like maybe somebody's got their truck or their insurance, or there's all sorts of things. And I know you can do things like add backs, but there's also this conflict of, well, if that person that was running that company, that generally is the brains behind the business, gets hit by a truck, what is it going to cost to replace them? And so what we would say is that's what true EBITDA is if that business was a standalone, what's that? What kind of revenues that, what kind of EBITDA is that company generating? So instead of arguing over getting hit by a truck and saying all that, we think of it as more of a revenue multiple. And the reason we think about that is because the way we run our operations is, and this gets back to why we acquire people that want to get out of the business, is we will buy people that want to get out because we know we're going to take their revenue and put our expenses underneath it. Now, there are some things that happen that we need to be aware of. So it's not like we just like toss all the expenses out. But what we know is if this has this many homes, we know exactly what it's going to take for us to run that business. And so when Josh comes to investment committee, he's already prepared for that. And so what we do is we say, here's the revenue that we're getting. And then Josh basically builds in, what is it going to be forever under Evernest? If this is a new platform acquisition, are we going to have to, either take over the rent or plan on rent? Are we going to need somebody to run that market? How many property managers? How many, what we call ITMs, which is international team members? We go through the whole gambit, and Josh breaks that down. And then we kind of have this form that we fill out. And then what we do is we convert that into a EBITDA multiple. And then that's how we view it on the back end because of the way we pay for these things now. Now, listen, when I first got into this business, if you're thinking about buying your first business, I could do most of the calculations on a napkin. And look, it's okay to do it that way because if it gets overly complicated, it's probably not something you should do. And so just know that, look, doing it on the back of a napkin is probably not a bad thing to do. But Josh, question on, what does the industry say is standard for these companies these days?
Yeah. So there is there's kind of a universal band, if you will, both on the top end and the bottom end. So the revenue and then the EBITDA or your net profitability multiple. The amount that people are willing to pay per door is really an output of kind of that calculation. So I wouldn't get into that, but typically all of the deals that are done happen on the revenue multiple side, somewhere between 1 and 1.5 times revenue. Few happen all the way up to 1.5. Most are kind of closer to that 1.2 threshold. But if you think back to what we were talking about before, and I would say 80% of companies probably sell within that 1 to 1.5. The other 20% may be lower or maybe a little bit higher than that. So, I mean, there's no like universal guarantee, but that's where the overwhelming majority of these deals wind up falling. And you'll hear that if you listen to other people that host these webinars and that sort of thing, you'll hear that same recurring theme. It's a pretty industry standard. But if you have $1 million revenue business, there's a big difference in $1 million and $1.5 million. I mean, at least for me, right? I mean, it would be if I were looking to sell my business. And so, what is that sliding scaling? How does that impact that? And what we were just talking about, those qualitative variables, is it strategically important to us? Is it do you have high Google ratings? Have you been in business for a long time? Or are you a fly by night operation that was there for a year and now you're just looking to get out? Are you well diversified? Are you well diversified with your owners? And are you consolidated geographically? I remember, and a lot of you won't be familiar with maybe with this territory reference, but one of the first deals that we looked at the beginning of last year was in Birmingham, but the portfolio was split roughly half in Birmingham and half in Montgomery. Well, Montgomery is about an hour and a half south of Birmingham, and we didn't have an office in Montgomery. And so that deal didn't make a lot of sense for us because we would have been scattered over an hour and a half drive time for our managers and for our technicians. And so those types of things do matter. And so as we go through and we qualify these other parts, that is where this sliding scale comes into. Are you truly a great business? And if you're truly a great business, then you can expect that lever to slide up. And then on the net profitability, typically you're seeing somewhere between 3 and 5 times. But if you think about it, it's usually going to be, again, kind of two sides of the same coin. Those numbers almost always even out. So if you're talking to somebody and they say, oh, well, we'll pay you, 2 to 6 times or 3 to 5 times your EBITDA, that number usually winds up being identical to that same 1 to 1.5 times top line revenue. If you are less profitable, if your net profit is below industry standard, it may sound great to be like, oh, I got a 10 times multiple. But that may just be a story because you weren't very profitable. But if you would have been industry standard profitability, it would have only been 3 to 5 times multiple. So typically what we see though is top line 1 to 1.5 and then the bottom line somewhere between 3 and 5.
Let me add one more variable to this that we hadn't discussed yet, and that is risk, right? If we've talked about what the list of things that we look for to help evaluate qualitatively the risk, but there's also terms of the deal. And if you think about it from a standpoint of who is assuming the risk of attrition? in this case, if Evernest assumes the risk of attrition, then we're going to pay less, right? Because we're going to account for some inevitable attrition that's going to happen. But if you're willing to take on more, or if the seller is willing to take on more, we're willing to pay more or have the potential to pay more because they're removing the risk. And really, we think about that in two buckets. One, we kind of have talked about is around some sort of attrition clause or clawback, meaning if I lose these houses, then you're going to give me this money back. And if I'm buying it, I'm either going to set that money up in escrow, or maybe I call it like a second, maybe some sort of loan that gets forgiven if those homes leave. The second piece of this is we like to use owner finance, seller finance. And so if the seller takes on the risk of financing the opportunity for us, we're willing to pay more money there because they're doing us a favor, right? Like we don't have to go to the bank, or we don't have to go to investors to get that capital to buy that business. And as you build a brand, as you build a reputation in the industry, you can get more and more seller finance just because people know who you are, they trust you, and a lot of the time sellers don't necessarily trust the stock market. They don't know what they're going to do if they got $1 million check. But this allows them to, earn some sort of interest rate on their money. So I see a bunch of questions coming in. Thanks, Jason and David, Richard. Y'all are throwing some questions in there. We are going to have, like I said, a section for questions. But I think now we're going to go onto the sales side, right?
Yep. We're going to start talking. This is for people like as you're thinking about and preparing your company. Maybe you're thinking about this year. This could be the year that I need to sell. Maybe you're planning out a little bit further to 2024, 2025. It's helpful to start thinking about like, how do I prepare my company to sell? Like, what are the things I need to be thinking about so that I can maximize my profit and maximize the value of my company, so that when I go to an Evernest or somebody down the street, that they're looking at me and saying, and it's checking all the boxes, like, wow. So we've already given you some of these things to be thinking about, right? The Google, the client concentration, some things you can do something about, maybe some you can't, but like MSA, things like that. But Josh, what are some other things, or Matthew, what are some other things that people need to be thinking about as they're preparing to eventually sell their company, whether it's in 3 months or 13 months?
So I'll jump off here and I'll say briefly, thank you. Looking at all these questions, hopefully we'll be able to get to some of these at the end. Great questions, and happy to answer any of those. One of the things that I love about here at Evernest, kind of the philosophy, is we really do approach things from a mindset of abundance. And so we have no reason to pull back information. I mean, whatever our thought processes are, we're happy to share with you. Even after this call, I know Spencer's going to share some of my contact information. If you're a buyer, if you're a seller, and you just want to have a casual conversation, always happy to do that. But one of the things that I would mention,
Josh, can I jump? Excuse me 1 second. I'm going to give it back to you. But if you're a buyer, I think this is incredibly important right now, because understanding the seller's mindset will help you be a better buyer. And what I have seen is when somebody doesn't understand the mindset or what's going through the mind and doesn't have empathy for the seller, you're likely to make some mistakes with them, because this is not, keep in mind, these they're not selling a car that they may have a little bit of an emotional attachment to it. Like, they are selling their livelihood. And so you really need to understand the mindset of a seller. And so we are going to have Misty and Steve on, who we just bought from, that are going to talk a little bit about that. But go ahead, Josh. Sorry about that.
Yeah, no, absolutely. So I want to go back to what we refer to internally as our investment memo, and it houses the qualitative data that we've discussed. It houses all of the quantitative financial data that we've discussed a little bit on. But one of the line items in there I wanted to address as a part of this question is we calculate what is effectively the management replacement value. And so what that means is, for a seller, is, are you a business owner or are you an employee, right? And you can be, shades of both. But as a seller, you are going to make yourself more valuable by having a team around you, if that's possible. Now, if you're at, 100 or under 100 units and you've got one or two people that are helping you out, that's not as much of an option. But if you're somewhere between, we see the average property management business that we evaluate somewhere between 200 and 400 units. And usually with that many units, there's a small team of people. And the more that you can become detached from the day-to-day, the more valuable that you are. I mean, there's kind of a rule in M&A. If you're a buyer, you don't want to buy a job, right? And if you are and if you're a seller, you can go ahead and start working now to get yourself as removed as is feasible from the day-to-day, so that when it comes time for you to sell, we're not having to, or that buyer isn't have to replace you as an employee as well. Now, sometimes that's just not feasible, right? Sometimes, depending on what your structure is and how you're set up, you may have to be involved very much in the day-to-day. But that is something I think that is not considered very much. Is people think, okay, well, I'm working more on the business, or I'm working more in the business than on it. But a lot of the sellers that we purchase from have taken the steps to remove themselves from the day-to-day to the extent that they can, and spend as much time as possible working on the business. And so when we go to evaluate that business, we're not having to effectively input another employee to take up what the owner has been doing. If they have a team around them that has been accomplishing that task, we know that's the less we're going to need the owner post-close to be around still taking care of their owners, if that makes sense. So begin to consider your business as an investment vehicle where you are looking to sell it, maximize your return. And to be able to do that, the more that you can be out of it, the more that you can be a true owner versus an employee in the business, the more valuable it can be.
All right. Thank you for that, Josh. So while Josh was talking, we brought in two sellers that are now Evernest team members. So just know they're not 100% objective, but I also want you to know that they took us for every dime we had. So if you're going to learn from two sellers, Misty, you're not supposed to gloat in front of us. If you're going to learn from two sellers, these are great to learn from. So want to welcome Misty Berger, who many of you, if you're from the NARPM community, she's been a regional VP for a long time and has contributed a ton to our community, to the property management community. She is in Colorado Springs. So Misty, welcome. And then Steve Brown, who I chased both of these folks for a long time. So they finally gave up and decided to sell to Evernest. So appreciate them doing that. And they decided that they wanted to come kind of grow this dream with us. And Steve Brown's down in Tampa and has taken over our Chief Revenue Officer role. So Steve, welcome. Appreciate y'all doing this. So what I've asked them to do, or what we've asked them to do, is just be really transparent. So even if it makes us look a little bit bad, that's okay. We've probably screwed some things up. So, well, why don't we start off with that, Misty?
And just real quick, if you have questions for either Misty or Steve or both of them, go ahead and put them in the chat. We'll see them and make sure they answer those.
Misty, I'll start off with you. What were like some negative things about the process that maybe you weren't prepared for that other folks that are selling can be prepared for?
So for me, I knew that you would want financials and that type of thing. I was prepared for that. I just wasn't prepared for the volume of paperwork that was needed. And at the time, it's needed quickly because you're in the middle of a contract. And so I could have been more prepared as far as having 3 and 4 years worth of statements, bank statements, all of that kind of stuff ready to go. And I was more prepared for about a year. So that was one of the things that if, I could advise someone is just to have all that prepared and ready to go and go back 3 years and have it handy in case it's asked for. And I want to say, Matthew, too, that when I met you in 2018, that was the first question that I asked you is what could I do better to make my business saleable? Because in 2018, I wasn't ready, but I knew at some point I wanted to be. And so I just wanted to share that you gave me the advice of making it not about me.
Wait, I gave you the
business.
advice that made me pay more money for that? That doesn't sound like a very smart thing to do.
I thought it worked out well. So
Good one. Well played. Well played. Steve, what would you say is like a surprising negative thing that happened during the sale?
I don't know that I would say there's anything surprising, but I do agree with what Misty's saying is, the amount of information that you need to have available and have available quickly and have it organized is an absolute must. And in our case, it was also a relatively short contract to close period. So I think that probably added another layer of anxiety, if you will, to the transaction. And it was really all about the communication piece with Josh and his team, and making sure that we were clear on what was needed and getting it over promptly.
Well, if y'all had sold to me back in 2018 when I first approached both of you, it would have been way easier. We didn't ask for any information. We just trusted you.
We had about 10 questions we asked. That was about it.
Yeah, I have to say this though, Matthew is persistent. That is true. I just got tired of it.
He just gave in.
But I think that's a lesson for all of you out there who are looking to buy. Like, this is it is a long-term relationship, and the way we kind of look at it is, and I know Matthew, like giving Misty advice, or he and Steve becoming friends, regardless if anything ever happened. Like, we just feel like, hey, we want to help people succeed and see people succeed, and then those relationships just flourish, and people know that we're looking to buy all the time, I think. So
it's a relationship kind of business. And so because Matthew did reach out and kept in touch, then it was a no-brainer when I decided to make the decision that would be a company that I would reach out to. So if I had never seen Matthew again, who knows in 2022 if I had even thought to reach out to him. So it is definitely relationship built.
And that's such an important thing to consider. If you're looking at buying a business, it's a property management business. It's the long game. You've got to take the approach of it being a long game, and it's all about the relationship. So to the extent that you'll commit to fostering those relationships, you'll have success. Maybe not right away, but over time you'll be successful.
Steve, what did you look for in a buyer? Like as you were processing this sale, like what were things that were important to you?
I think if I take this back to the beginning, so Rent Network was 10 years old at the time that it was acquired by Evernest, and from day one it was built to be either sold or to function independently of me. And so we had the luxury of building something from day one that would support that. The first 5 years or so, I was relatively absent. And then the last 5 years, I was a little more present as we were putting more systems, process, people, and so on in place. And when I started to have conversations about, all right, I know I want to, sell this at some point. It was about the company, who are they? Is there, I thought about my team, quite frankly, and what does that look like? And how does it impact them? How does it impact our clients? As you grow, it's hard to remember everybody, but every one of us have those clients that we've had for many, many years, and you want to know they're going to be taken care of. We focused very much on the reputation side of things in our market area, and worked very, very hard for our Google ratings. So, making sure we were aligning with a company that had a similar appreciation for that was so important. So don't get me wrong, the financial aspect of selling your company is, super important. But at the same time, you do have to look at what I consider to be from the seller's perspective, things that are a little bit more qualitative. So those were the things that were important to me.
Yeah, we always say the 3 questions that sellers always ask are, first one is, how much do you pay? The second one is, what are you going to do with my team? And then the third one is, what does the process look like? And so, a lot of, when we have an introductory call with a seller, that's the first things that they want to know. And so Josh has a number of he probably has his answer to those three questions down pretty pat. But, and Missy, I would ask you the same thing. I mean, as you were kind of like thinking through this process and talking, I know you talked to a number of companies, what were you looking for in a seller? And keep in mind, everybody, we're not saying this so they can we can brag about us, but again, you're trying to get into the mind of the seller if you're a buyer, but also trying to get into, if you are a seller, kind of making sure that you're prepared for something like this. And so that's the whole idea of this. So Missy, sorry, I jumped in, but talk about your thought process around selling.
So because I am on the board of National, I certainly knew a lot of the players that were moving in the market, which worked in my advantage, I believe, because I picked the top 3 and sent those over to the companies that I was interested in. And then I scheduled appointments to do one-on-ones with them because I wanted to compare culture and I wanted to compare how they handled their transitions. And there was just a lot of fact finding on my end. And Steve is right. You can't take the financial part of the picture out of the equation. But after that's been addressed, it's how is it going to relate to my owners and to my staff? And in the end, the decision became Evernest after all of those interviews. And so that's how I chose.
Awesome. Thank you for that. So I would like talk about a little bit about the process. Steve, Missy, why don't you start? How long did your process take from essentially deciding to sell, choosing a buyer, and then to close? Talk about that process, what that looked like for folks.
So I made the decision in October of 2022, and I was pretty prepared at that point. And from that point to the date of closing with the company I chose, which is Evernest, was 60 days.
Yep, that's great.
That's pretty quick.
Yeah.
And
Well, and actually it was really 45 if you think about it, because the commitment wasn't made until October 15th, and then boom from there. So that time, and I'm sure Steve will agree, it goes by extremely quickly and extremely stressful.
Yeah, because those financials, you got to have those financials.
Steve, you were an even shorter timeline, right?
Yeah, it was a really, really fast timeline. We closed on essentially November 30th, I guess, and we had finalized the initial LOI probably late October. So it was a pretty short timeline. I remember thinking at the time, it's like, let's just get this done. What do we need, a week or two? And then I'm like, then it was just like, to Misty's point, it time flies. It went by quickly, and it's like, let's get it done.
I think for me, it was probably the biggest emotional roller coaster that I've had in a very long time in my life. So up and down. So,
but it all worked out. Look, when we first started, obviously we wouldn't been able to close on Steve or Misty's business in 30 or 45 days like we were, but we had done it enough times. We kind of we have this pretty exhaustive checklist that we go through. And that's what I would suggest if you're a buyer, is make sure that you've kind of created your checklist of all the things that you need to do, not only pre-transaction from LOI and contract and then closing, but even post, right? Like, what is your integration plan to make sure that you're bringing these homes into your process? So, really important to get that taken care of.
What I would add to that, and it's so nice that we're willing to share that checklist with people. And Matthew's joked about, in the early days and doing all this on the back of a napkin, but having a process in place where step by step what you need and when you need it, and making sure you have it will certainly help the process go so much smoother. In my case, I always felt like we need this and here's why. And it was a kind of a natural progression.
As things are swirling, obviously you're building up to closing. Like there's so many things going on. It is stressful. Like Misty said, you've got to have something that kind of like keeps you on track. And so the way we think about that, if anybody's read the book Scrum, and this is a way to essentially do development, software development, but we basically incorporate it to us is as we're building up to close, we might, Josh, if it's 60 days out, may start having a once a week Scrum meeting. And we're going through kind of like all the things that we need to do. And then as we get closer, it may be twice a week. And then we might move to every day, the 2 weeks before we close. And then basically all you're doing is you're assigning those things out. We use Asana to manage that. You're assigning those things out to people that need to get them done, right? Like real estate licenses and brokerages and trust accounts and reconciliations of tenant funds and owner funds. And there's all these like bits and pieces that need to be put together. But if you don't have a checklist, then you're going to miss a lot of that. And so that's the way we manage it is through Asana and through our acquisition checklist. If you have some questions and you want to start throwing them in the chat channel, please do that. I know we have a number of people that are doing that, but we're gonna pause here in about we're going to talk about another 5 or 10 minutes. With Misty and Steve, and they're going to hang on also for questions. So if you want to ask them questions, we'll definitely do that as well. So my next question would just be, what do you think? What do you think went well in the process? What were you kind of pleased about as you went through this?
So I'll go first. First of all, I think that the acquisition team kept us on task very well. Josh, we met, by Zoom every week, like he said, and I'm at the end, I'm sure he probably had his phone attached to his ear because it was phone calls and attorneys and everything constant until we closed. And in fact, the closing was delayed due to an attorney. And so that part of it, they did very well. The part that didn't go well, and I know that Evernest is working to improve it, was what happened after the closing. And so there's a lot of steps that happen after closing for the team that's in place that stayed. And so that part of it, while they shared with us what was going to happen, when that didn't happen like they said, that caused some strife in our office. And so but the team has worked really hard to overcome that as well. And so to me, it's like if you have a vendor, right, and they mess up a job, I give them the opportunity to make it right. And if they've made it right, then I can't ask for anything more. And it's the same thing in business. And so they stepped in and said, you know what, we dropped the ball here, let's get this going. And so I would say the good was great, and this is getting better.
So it's around like when you're acquiring, it's all about communication, setting expectations, and then also delivering on those expectations. Yep. Steve,
Yeah, I very, very, very similar. The communication was just awesome. It truly was. The kind of the way it was communicated, how often it was communicated. I really appreciated that. And as somebody who, as Misty said, it's a kind of a big deal. You can be emotional about it, and the not knowing sometimes creates problems that don't exist. So the communication side of it was really good. A couple closing hiccups, but nothing significant on our end that I look at and say it was anything other than just a few things at the end, dot the I's, cross the T's. I think the most stressful part of that for us was that period of time where you have to lock down the trust accounts and then get everything transferred over. That was a hard thing to get my arms around. And part of it is just the financial guy in me that just the numbers part of it. I have always kept close rein on that. And I think there are some things that we identified we could have done differently that would have made that process go a little bit a little bit smoother. But that was difficult.
And I hope everybody hears that. Like we've already gotten some of this feedback from Steve and Misty. I mean, clearly they're on the team, so they're trying to make it better. But you may have done something 37 times, but there's always a way to get better, right? Like if you have an attitude of how can we make this better, how can we improve it? And Tim, who runs, a lot of people know Tim Wayner, who's the president of NARPM this year. He runs our M&A team and has an acquisition integration team. Actually has 3 teams now. And they were here in Birmingham 2 or 3 weeks ago, basically working on the processes. So we took a strategic pause over the first 90 days of the year. We had a big end of the year. Kudos to Josh and his team. We bought a bunch of businesses on October 31st, November 30th, and December 31st. So Josh then took the first part of January off. So we're only just now getting to see him again. But the point is, we strategically pause so that we can focus on improving the process, right? Like how can we make the future Steves and Misties, how can we make their lives easier? How can we make it go a lot smoother so that they don't have any challenges? I'm sure we'll figure out a new way to screw it up, but we'll do our best to make sure we get it handled. One of the things I would be interested in is talk a little bit about advisors, like maybe attorneys, or Misty, you even used a broker. Talk a little bit about how advisors, how y'all thought about it. Just kind of expound on that.
So I think one thing, if you are considering selling your business, one of the first contacts you need to talk to is your accountant, because it is going to change your world financially and with the IRS. And so I started with my accountant, and then I got recommended to a business broker because I am too emotional about my clients, about my staff, about my business. And I'm a people person, but I'm not a financial guru. And so I needed to bring in people that could help me make good decisions. And so with the business broker, then we decided to do a special deferred trust, which brought in an attorney for the trust and an attorney for me. And then you guys had an attorney. So I had a team. I had a big team, but in the end, it was the best decision I ever made.
That's great. Yeah.
So.
Hiring attorneys. And one of the things I would say, advice around hiring attorneys, is attorneys that are familiar with transactions is super important. Just because you're like, if you have like a family attorney or a brother-in-law or whatever, we would rather, as a buyer, your attorney be more sophisticated on the transaction work, because it makes things go smoother, right? Like they're used to seeing certain things. That way they're not like trying to learn on the job. And so, you can find these transaction attorneys. They're all over the place in every city. Steve, how would you think about hiring advisors?
In my case, what I would say is my attorney was the emotional one.
I wasn't going to say anything.
No, I'm smiling here for a reason. So, look, I have a handful of attorneys I've used for just different business related things, and the decision I made for the attorney I ultimately ended up working with this, I guess in the end was fine. But you need to be very, very sure that attorney is clearly understands what your intentions are and what you're looking to accomplish with this. Now, of course, you want their expertise and whether you're on the buy side or the sell side. You want their expertise, and you want to know that everything is being done properly. But you need somebody who really understands you and what you're looking to accomplish, what your goals are. And at least in my case, I wasn't completely intimidated by the process. and I looked at this in terms of, I know what I want to get done. We just need to make sure that all of that is reflected in the agreements we're signing, right? Because the intentions are great, but you need to make sure that everything is reflected in those agreements. So for me, part of this is the experience piece. My attorney was a little emotional, quite frankly. But part of it too is that you got to have somebody who can guide you and take you down the path. Make sure they, mine had his best interests in.
Definitely was looking
mind,
out for
sure.
Steve, and that's what you really want an attorney at the heart of it. And one of
You
the great
do.
things about our relationship is we can laugh about these things, right? Like Evernest screwed some things up. This is all about all of us getting better together, and that's really the heart of what's going on here at Evernest. So I'm going to start hitting some questions, and
Matthew, before we jump into that, I wanted to ask both Misty and Steve, just for the edification of the people who may have any interest in selling at some point in the future, the most common fear that I hear from potential sellers is, what does this mean for my team? And what is going to happen when I tell them? These are people that I've provided them a paycheck. I have, in some cases, they have relocated to work for me. These are people that I've known for years. I know what their children do. I know what, their grandchildren do. And then I'm going to feel like I'm abandoning them when I tell them. And so I would say, there's a tremendous amount of things that create stress in a seller's mind throughout the entire process, but it probably all reaches a crescendo the night before there's going to be a conversation either with their executive team or their entire team, letting them know that they're going to be selling. So I'd be curious to hear from Misty and Steve. Again, number one thing that people seem to have a fear over is having that conversation with their team. So Steve, let's start with you.
And along with that is, when do you have
Exactly.
that conversation?
Mhm.
Mm-hmm.
At what point during the process? You're 100% right. That was, I thought about that from day one. So on the one hand, all of the things you're saying, Josh, are absolutely right. You care about them. They've helped you build your business. They've been with you a long time. They're loyal. And in my case, that was all of the above. And, I struggled with, the timing of it, when to tell them, how to tell them, and wanting to make sure that when I did, that I was being clear about, here's what to expect as this happens. And it didn't help that in my case, and probably Misty's as well, that we're kind of looking at this at the start of the holiday season too, right? And we had, people out and vacations and those types of things. But you do have to have a very clear, plan of communication with your team when you tell them. And the approach I took was to meet with the key leaders of our team individually and then collectively, and talk through, this is what we're doing, and this is what it looks like. It was incredibly stressful, and probably stressful in the sense that, you're making the right decision, but you need to make sure that the team understands that as well.
I agree with Steve, and I think at some point during the conversation in your mind that you're thinking of selling, once you make that decision, you have to understand that what you have set up is not necessarily going to be what the buyer is going to use or set up for their business. And so you cannot, as a seller, expect somebody to take on all your luggage that you may have in your office at the time that works for you, but may not work for them. And so I brought in my business coach, and we planned a meeting, and we just sat down and we hashed out a lot of things and met their concerns head on about, the what ifs, because that's what was scaring them, right? Well, what if, what am I going to lose my job? And so we were able to do that. And then Evernest sent a team from Birmingham into our office and had a conversation with my staff. And that not only meant a lot to me, but it meant a lot to them because it showed that they had a concern about what was going to happen with the team. And they were very honest with them. The questions that they could answer, they answered, and the ones that were maybe something that needed a further discussion was shared that they would get back to them. So yeah, that probably for me was the toughest part of the whole deal was what's going to happen to my
Misty,
team.
it's not super hard to get people to go from Birmingham to Colorado Springs or Tampa. So
I was
everybody. I'm just
I
kidding.
was thrilled. Misty introduced us to a wonderful restaurant there in Colorado Springs after that meeting, and I ordered.
We need to do it
I
again,
ordered way
Josh.
too much asparagus for some reason. I still can't figure out why I got so many servings of it.
That's
But,
Matthew's favorite, but no, it's Brussels sprouts.
All right, let's talk.
Yeah, we've got questions. So now what we're going to do, we're going to shift gears. We've got a lot of questions over here. We're going to try to get through these as quickly as possible. And then also what I do want to say is I am going to drop a link here. We would love your feedback. So we want to make this better. This is going to be a monthly webinar series. We're going to have sales next month. We're bringing some sales veterans on. They're going to actually battle it out.
Yeah.
We're going to talk about.
And Evernest brought in 500 doors in January. So,
Yep. So we'll be
know
there.
a little bit about.
Yeah, we'll be represented there. So I'm going to send a link. What I'm looking for is just a Google form. However we can improve this webinar, I'd love your feedback. It's anonymous. You can say whatever you want to. If you want me to get rid of Matthew, I'll do it.
Especially
It's
about this
easy.
guy.
Like, he can't even log on his computer. He's in my office. So he's like, this is pretty funny. So let's get into the question.
Yeah, I mean, look, all of y'all that have asked about my hair product, look, I'll be happy to send y'all an email with a link to that on Amazon. So, I think there's 8 or 10 of you that asked that question. So, kidding. Look, there is a question for Misty and Steve, and really Josh too. Were there any conditions that Misty or Steve wanted that were not standard for the Evernest buy box? If so, how were they evaluated and addressed? Does that ring a bell for any of y'all?
So that's probably more so, I guess, for me, being familiar with our buy box. No, so with every business, like there is no cookie cutter deal, right? I mean, we usually start with a boilerplate contract that entails most of the generic terms, and then we leave it up to either an attorney or the multitude of attorneys to then carve that thing like a Halloween pumpkin. And so, no, but seriously, from there, you've got attorneys that usually there's a little bit of back and forth, and there are always some type of a concession that's going to be requested. Some of those things we can accommodate, some of them we can't. There are some new things, like for instance, Misty's is the first time we had to allocate the proceeds to a trust. And so that was something that we weren't familiar with. We went through that process. We were able to accommodate that, but I don't recall there being anything really outside of the ordinary. Well, I would say the only thing that I can think of, we typically in these deals don't take on a lot of tangible assets. So there is something that if you sell your company, there is a form that you'll fill out after you've sold your company called a Form 8594, in which you will designate of what you sold, what was a tangible versus an intangible asset. Tangible assets are taxed at a different rate in sales than intangible assets. And so if you get into FF&E, which is your furniture, fixtures, and equipment, if you sell FF&E, that will need to be listed on an 8594 if it's itemized and included in your in the sale of your company. And you'll be taxed, and your buyer will be taxed differently on how you allocate the purchase price. So if, for instance, you sold your company for $1 million, 900,000 of that was allocated to the value of the management agreements, which would be 90% or $900,000, and then 10% or $100,000 was allocated to FF&E. That's going to be taxed differently. So in Misty's instance, there was a vehicle that was included. A lot of times, a Subaru, yeah, all-wheel drive, maybe Colorado Springs. What else are you going to have? And so that's not real common. We have purchased tangible assets. That was probably the most, I would say that was the only kind of uncommon part of that. But all of it, I mean, look, the relationship, again, you're purchasing the trust and the goodwill. Matter of fact, the actual document that we use is called an asset and goodwill purchase agreement. And a significant amount of the value is the goodwill of the company, right? I mean, because in a property management company, the overwhelming majority of companies, their tangible asset is the management agreement. I mean, that is where the value lies. And the intrinsic value of that management agreement is actually in the relationship between that property manager and the owner who have signed that contract together. And so outside of that, I don't think there was anything super unique, but maybe Misty or Steve could correct me on that.
Steve, would you answer that any?
No, I can't say that I think there was anything unique about mine that or any concessions that were made that were unique to this
Yeah, we had
transaction.
an employment agreement with both of y'all that we had to work out that might have been unique. That it's not something that appears typically on a regular close. But all right, Misty, there's a question from Richard. It says, was your business coach the business broker or a different individual?
So I had a business coach. I brought a business coach in about 3 years ago, not only to help me, but more so for my team. And so that this person had a personal relationship with all of my staff and was able to, when that meeting happened, she led that meeting and just started right off with all the fears and everything that they may have individually. We just went around the table and had a really frank discussion. And so it was two separate people.
All right. So Tammy's asking, Matt, curious, what is the percentage of keeping the CEO of a purchase on for a time after? So I'm guessing like there's two answers to this question. Like how many people did we bring on full time? And we've only done 3 of those that I can think of. So 2 of them are here, Steve and Misty, and then also Tim Wayner, who runs our whole M&A business. And then there's also like how long does the owner need to stay on post transition, even if they are rolling off, like retiring or doing whatever. And under our model, because we moved like day 1 onto the Evernest process, we ask people to stay on 60 days. You know, my experience, we don't necessarily need them after about 30 days. So that's how quick we're able to move them onto our system.
Quick question, Steve, Misty, how many employees did you both have?
I had 6.
Including ITMs, we had 19.
Tammy wants to know, Misty, would you share your business coach with us? Where did you find her suggestions? So we'll talk about that. Maybe we can do that after, or maybe post it in the show notes. Or, I mean, I don't know, Misty, maybe you're willing to just say who the business coach is. But I read that before. I thought, wow, this is dangerous in the middle of reading it. But
No, she actually did a seminar at NARPM too, but her name is Kelly Eikenberry, and anybody can reach out to me. She does it over the internet as well, so she doesn't have to be there in whatever city or state you're in, but yeah, anybody who's running their business, I would recommend it. It's a wonderful
thing. Yeah, there's nothing like having somebody that's objective and not emotionally attached that you can bounce ideas off of.
Exactly.
Yeah, go ahead. Have you heard of anyone selling half their doors under management, still keeping their business, looking to downsize, but not let go of the company? I'm at 600 doors, mostly single family. Thanks. Love the podcast and this webinar. Awesome. It's from Misty. That's not from you, though. Is it, Misty? Apparently there's another Misty out there. Look, yes, I have heard of selling the doors. Here's the big challenge with that is just the non-competition. So when you sell your business, there's also this non-competition and non-solicitation agreement that you're probably going to sign along with that. And so you would just have to narrow the non-competition, non-solicitation, because as a buyer, the last thing we want to do is come buy relationships and then have you pay you a bunch of money for it, and then you come and solicit their business back, right? Like you sell ABC management company, and then you start XYZ management company, and then all those relationships you start pulling over. So I think it would be a challenge, but it's certainly something you could do. I actually have heard of that. If anybody knows Robert Locke over in Atlanta, actually sold off portions of his business. It would probably be easier if you're in a big metro and you're selling areas of town versus, hand picking your bad properties.
How about this one?
How do we value a business? Our accountant says it is valued at one amount that I feel is way too high. So where do I start to have a valuation on it? Is there a special accountant type? Look, yeah, I mean, here's the big issue with accountants is accountants are very much generalists unless they're like deep in the weeds of this business. And so what I would tell you is an accountant's probably not the right person to help you with the valuation of your business. Look, this is like a selfish promotion, but I'm going to do it anyways. I would spend more time talking to somebody like Josh, and Josh can give you an idea of look, you don't have to, there's like no strings attached, but Josh can give you a better idea of what your business is worth, in my opinion, than an accountant. And look, clearly you can call any one of the number of people that are out there buying property management business, and then you can kind of like triangulate what they're offering relative to the value of your company.
The best approach is to take input from somebody like Josh, talk to your accountant, make sure you're looking at both sides of it as you're looking to make a decision.
If you're a smaller company, how do you get on the radar of bigger companies to entice them to look at you? Along with that, what are the beginning steps to market your company for selling it?
Call Josh.
Yeah, look, this is not a Josh webinar. We don't, but look, even if you're a smaller company, one of the things I would say, like, I don't know what smaller means, but one of the things I would say is like a company like ours is interested in buying. And look, there's other big companies out there, right? Like there are probably 5 or 6 of them that are buying businesses. But what I would say is anybody who has if you're a smaller company, so I would think this is like less than 100 doors. Anybody that already has a presence in your market is going to be more likely to buy you. So the way we think about that is if somebody has 100 doors in, let's say, a market we're not in, which is, Sioux Falls, South Dakota. We're not going to go buy a business just $100 in Sioux Falls, South Dakota, just because we can't make money on 100 doors the way we're set up. And so for us, it becomes more like 200 to 300 doors is where we'd like to see a company, so that we would do a platform acquisition. And so if you're a smaller company, I would call the players that are in your market, and you see the signs, you know who's there, and talk to them about it, because we would love to find, call it 100 or 50. We love to find those smaller property management companies in markets that we're already in.
And let me just say real quick, feel free, a lot of what I do is just kind of acting as a friend to property management owners. If you're just curious, I'm happy to talk to you, give you some ideas. And if we know somebody who's buying in a market that we don't currently exist in, I'd be happy to connect you with somebody in that market.
David asked a question right there below that. How many units or revenue would you need to expand to a new market? So again, I kind of said that in the last one. The way we think about that is 300 units. And for us, 300 units is probably like a normal property management company is around 600,000 in revenue, probably like 550 to 600,000 in revenue, just based on property management fees. The average company we see is doing about $1,800 to $2,000 annually in PM fees. So leasing, the monthly management fees, renewal fees, application fees, that's kind of how we look at that. Do you recommend we maintain the owner's current management fee structure during the period of the earnout, or switch the owners to our standard fee structure at signing? So the way we think about that is we want to develop trust with the owner. And if you come in and change a lot of stuff right off the bat, it's going to feel very, there's going to create a lot of friction. Now, there are some markets, I know Arizona is like this, that require an assignment of the management agreement. So if that is the case, you may want to go ahead and just get a new management agreement signed with your brand or your management agreement, since that's what's required. But generally speaking, we assign, so Misty and Steve just assign their management agreements over to us. And then we basically leave those in place for at least 2 years. And we think especially when you have a lot of one house, one owner, you just don't have enough interactions with them on a regular basis to build trust. And it takes a couple of years to do that. So, do you consider brokerage to be a part of the revenue calculation, assuming that brokerage is an ongoing concern and doesn't do just one-off deals? Yeah. So the answer is no. We think of brokerage as more transactional. Now, look, if somebody has set up a brokerage machine, we could probably look at that as being different. Or if there's, if there's like something there other than just, regular brokerage deals. The challenge with brokers is they're not super sticky. And so the challenges that we had, the way we would think about that is, is somebody going to keep that brokerage? If they do keep it, then we want to make sure that when we buy those management agreements, that they're not rating the portfolio that we buy to broker more deals. And so we set up some sort of referral agreement. In the event we buy a property management agreement and then it goes to that broker, then we're going to get reimbursed generally for that property management agreement. But we don't really think of brokerage dollars. And I do know, you can probably show some historical consistency around these brokerage transactions, but we don't typically think of that. What we want is recurring revenue, which is the management fees, and reoccurring revenue, which is generally things like maintenance. If you manage 300 homes, we don't know which toilet is breaking, but we know that there's a toilet breaking somewhere. So hope that's helpful. Would you consider maintenance income as a part of the revenue? Yes, as long as it is W-2 maintenance techs, and we can inherit those maintenance techs. So we would consider that maintenance income. I have approximately 2,500 doors. I'm not reading off the name of that. Is that size sellable? Absolutely. No, look, Marianne, yes, 2,500 doors is absolutely sellable. We bought a business last year that was almost 3,500 doors. So it is definitely a sellable business. What else? Have you provided sellers with a referral fee if we sell a referred property within the first year or two as an added value? Absolutely. Part of our standard agreement includes a referral fee, right? Because you've developed these relationships over time and you're going to get that phone call still. And so even though you're off doing something else, maybe cruising the Caribbean or skiing somewhere in near Misty, we still want you to take that phone call and send it our way because we want more and more doors. So we absolutely have a referral agreement in place. Jason would like to know, do you find sellers, and Josh, why don't you answer this since I've taken all the questions so far.
The easy ones.
Do you find sellers are open to earnout versus payout structure? In previous acquisitions, we have determined a multiplier for recurring and non-recurring services and then pay 50% per month until the earnout period is completed.
So in a traditional earnout, and I'm not certain if this is what you mean by that, but in typical M&A speak, an earnout is going to be usually something above and beyond what the seller and the buyer can come to terms with. So if you said, as a buyer, I want to buy your business for $1 million. The seller said I'm worth $1.5 million. That $500,000 delta, you may put into an earnout to say if certain conditions are met, then we will pay the additional $500,000. We would offer a structure like that. To my knowledge, we've never done anything quite like that, but we do have that kind of in our toolkit. What I think you may be saying instead is you're paying 50% kind of upfront, maybe, and then the balance, if certain conditions are met, that is almost more of what I would consider like a reverse clawback, where you're providing a guarantee, and then if what you and then if the 100% revenue is met, then you'll pay out the balance. We have done, and maybe a better way to answer the question is, we have done deals with all structures. We have done deals where it's a revenue share, where we say, hey, we will pass through revenue for a period of time. We typically do that for what we consider slightly more risky businesses to buy. Typically, it's going to be either a straight all cash offer, or it's going to be an offer with a certain percentage down and then the balance financed over a certain amount of years if they want to sell or finance it. So
All
that
right.
answered your question, but I hope it did.
Let's keep rolling. Brad would like to know, Misty or Steve, would you mind sharing how the size, maybe the number of units you managed when we bought you?
So I think we're the same. Steve and I both had about 450 doors.
There you go.
That's correct.
Awesome.
I've answered a lot.
Question for the group, possibly. More PM companies have incorporated. Oh, wait, we said that already.
We've gotten a lot of them.
We have a lot of around.
Somebody
valuation.
did ask, was there a
here's some.
software that we used to get our 5-star reviews? And that is something probably 6 or 7 years ago. We were like, man, our reviews are horrible. I think we were maybe just in Birmingham and in Nashville. And we found this software. Somebody that worked on our team sent it to me one weekend, called Podium. And so we spoke to Podium. It was expensive at the time. It may be more expensive now, but I can promise you it's worth every penny of it. It makes asking for a review, and more importantly, it makes giving a review very, very easy. And so then we just challenged our team and incentivized our team to ask for reviews all the time. And so we have quarterly contests for reviews. And if you go look up Evernest Birmingham on Google and just kind of look at our Google My Business, we probably started out at 100 and something reviews, and we were maybe at a 3.4 or 3.3, just because it was the tenants who were complaining. But then we started actively asking for reviews, so it's improved, obviously. Christopher would like to know, what types of functions do you outsource? So I'm guessing this is a general Evernest question. Right now, we are outsourcing some of the underwriting of residents. We are outsourcing, some of the property accounting, like the transactional property accounting. Yeah, that's about it. So the thing that I have found as we've scaled the business, it's been really hard for folks to scale with us. So you can imagine you give a lot of business to somebody, and as you grow the business, it's just hard for them to scale along with you. And so this will happen with vendors in the market as you go from 5 yards to cut on average to 50. They've become all of a sudden this landscape business and have tons of people, and it's hard for them to go from being a grass cutter to a manager of people. And so what we've tried to do is insource as much of that as possible. How do you handle a company that has a diverse portfolio of mixed assets, meaning like commercial, third party, and owned? Anything somebody owns, we don't really, we would prefer not to buy that. We prefer to just earn that business. We don't handle commercial. So if somebody comes to us with mixed stuff, it's probably not something that we're going to chase after. We would want just the residential stuff, but this would be a case where we would want them to break that apart. I saw
question up here from Tammy. She has a couple of questions here. She says, so as I build this PM company, I want to have more owners owning under 5 properties. Is that smarter? Look, a lot of it is just around your strategy. I've seen a lot of great property managers that are great at specializing in the investor owner. And so it's really just around the strategy. Now, if you're selling the business, yes, the one house, more of the one house, one owner, less client concentration is more desirable. But if you're a great, and it looks like you're also a sales broker, and if you're able to help them buy more, then you're able to keep the management. That's actually how I got into the business. So I was helping people buy houses, and ultimately they wanted me to manage them. And so that's how we inevitably got into the business in the first place. So again, it's all about your strategy, Tammy. What do you want out of this business? And I would say, go after it. And then I wouldn't necessarily tweak it for selling if there's something you're really good at. It doesn't mean that you can't sell a business that has an average of 5 properties per person. I mean, that's definitely a very sellable business. All right, we're just going to keep rolling. We manage homeowners association. Does this meeting pertain to companies like ours? Well, Alan, if we also manage homeowners association, so I hope you're still here, and I hope you thought you got some value out of it. But there's obviously some tweaks to HOAs, but hope that it was helpful. Let's see. How do you let's see. Yep, a lot of valuation questions. All right, let's see if they're added any more. Do you do any STR?
Short term.
We don't. Yeah, thank you for that.
We didn't even know what it was.
Clearly
so
we don't.
We don't do that.
Clearly we don't. Don't yet. We do. It is on our roadmap though. What is everyone charging for tenant fees currently? Flat fee or percentage? We don't want to get into any issues right now, so we can't answer that. Misty would tell you that NARPM's very adamant about making sure we don't charge fees. So, yeah.
Please don't.
Spencer's too pretty to be in jail. So, let's see. Y'all, I think we are done with the questions with 5 minutes to spare. So instead of just hearing Spencer and I talk, we're going to wrap this thing up. Again, I want to thank Appfolio for sponsoring the event. They've been a great partner of ours. We've been on Appfolio for the last 6 or 7 years.
Longer than that, almost. We're on year 9.
Okay. You're not supposed to make me look bad on screen.
This is my chance.
Yeah, so we've been, it's just like a great marriage. It feels way shorter than it actually has been. So kudos to Appfolio for helping us with this. Remember, sign up for our next webinar. If we were smart, if Spencer
we don't have a link for you.
We would already have the link ready for you to sign up. Just watch for it. We're going to send that out. Spencer here lives moment to moment. And so he should have had that already done. Anything else we need to hit? Oh, listen to our podcast.
Yeah, 300 to 3,000. Go and subscribe.
If Spencer had half a brain, he would have been ready for that too.
That's right. I wasn't ready for that. Hey, this is our first one.
Yeah,
this is our first one.
Clearly, we're rookies. This is the last time I hope I have to do this standing next to Spencer. So
my back is hurting.
All right, everybody.
Thanks for joining us, Misty and Steve and Josh. Thank you all for being here. Added a ton of value.
Great job, everyone. Bye, everybody.